Another bullish call today on the banks. This time JPMorgan upgraded to a buy. $116 is the price target. That coming today from Goldman Sachs. It is our call of the day. We had maybe a call of the week from our own Jim Cramer a few days ago when he was on this program about JPMorgan and Wells Fargo. Let's listen.
JPMorgan is not the stock to own in this market. I'm really sorry. I own it because of some silly thing called diversification. And I just feel like there's a piece from Goldman Sachs, Balance Bear Repair, talking about diversification and how it could hurt you. I have single stock risk in JPMorgan. Fortunately, I have single stock risk in Apple and in Facebook and in Alphabet and Microsoft for my trust. But I've got it in JPMorgan. I'd rather actually be in Wells Fargo than JPMorgan right now because Scharf is...
Really? Okay, he's talking about the CEO, Charlie Scharf of Wells Fargo. Steph, I thought of you immediately. In fact, I mentioned your name on the show in the context of our conversation. So I'm going to go to you first because you own Wells Fargo, and you have made the case repeatedly that that is the one to own. Why?
Yeah, I mean, I own three. I mean, I own Wells Fargo, I own Bank of America, and Morgan Stanley, and they're all story stocks, right? I mean, I understand why people want to own JPMorgan, but it also happens because it's quality. He's got a great balance sheet, great CEO. Everybody loves Jamie Dimon. Everybody knows who he is, that sort of thing. And it is a great, great company, but it's also the most expensive stock on a price to book and also on PE basis. And it's also more of a defensive bank. It'll hold up better than most in a decline, but it won't participate. If you really think banks are going to move, it'll lag. It will definitely lag the group. So I own Wells Fargo is really the CEO making all of these substantial changes to the executive team. I mentioned the other day, he's hired 6 new managers, executive managers since October, and he's really changing the culture of the place. And that's what needed to happen. There's a ton of costs that they can take out. They are going to lay off probably about 10,000 people. So there is room on the margin side as well. And I think that they took enough in terms of the reserves at $8.8 billion. I think that was enough, and it was a lot more than I thought. And I think they're protected if the environment kind of stays like the way it is in terms of the economy.
Okay. So, Josh Brown, you've made the case, and I know I remember you making the case on multiple occasions that anytime JPMorgan has gotten around this level, 98, north of 98, towards $100, it always gets over $100. Now, in full disclosure, Jim Cramer owns JPMorgan. It's not like he doesn't own it. He owns it. He feels stuck in it. And he says Wells Fargo is a better place to be. What about this call by Jim, not JPMorgan, not in this market?
Well, I actually agree with everything Stephanie just said. I just reach a different conclusion based on what she said. So I'm not as hopeful about a banking rebound in the second half of this year. I think she's more optimistic about the economy and about the chance for a cyclical upturn, and I'm not. So that's why I would take the same set of facts she just laid out, which are undeniably true, and bias myself toward rather being in JPMorgan. And part of the upgrade today from Goldman was that JPMorgan, in its severe adverse scenario, has about 70% of the losses it would need to reserve against already reserved against. So in other words, they are more prepared for a continued challenging environment. And if I'm wrong about that, and if all of a sudden we're back to 2.5%, 3% GDP growth in the second half of this year, which is definitely possible, I agree, Wells Fargo and other cheaper, more downtrodden banks that are more susceptible, they'll do better, like stock-wise. But for me, it's total return. So I have JPMorgan right now, 13 times earnings. I have a 3.65% dividend yield that I think is more than amply covered. And I have the best leadership and management in the entire industry so that if things don't go well, I think that I will be more protected than, for example, a Morgan Stanley. But either scenario could play out.
Right.
And I think two investors could look at the same set of facts and reach a different conclusion about what they want out of the equity opportunity. So that's where I am.
Shannon, Cramer says don't own JPMorgan. Goldman today says own JPMorgan. They overweight it, or they upgrade it to a buy. The target goes to 116. Who's right?
I think I want to own JPMorgan. I mean, I own JPMorgan, so obviously I like owning it. I agree.
Jim is not going to be offended, I promise. Don't worry. He's not going to be
no,
offended if you say you think Goldman's right. It's okay.
I think Goldman's
Jim's
right.
a big boy. He can
I
take it. He gets it. He owns it.
I think it's because I would rather lever myself in the back half of this year to an economic recovery in other value sectors. I think coming into this year, Scott, we talked all about how financials needed to lead the way on the value rotation. And I think that is incorrect now. I think that there are other places, if you want to lever yourself to a value rotation, there are better places to do it than in big banks. And so I have some financials exposure. JPMorgan is the big bank exposure that I have. And then I have other financials exposure because I don't think that is where I want to put my chips in a potential value rotation today.
Okay.